All right, we continue with our program. And now we are gonna dive into token design optimization strategies after we've learned a lot about token launches. And the first speaker actually that I asked to come to this token engineering track day was Mark Richardson from Carbon. And I told him, you know what, I would love to discuss Carbon as a new primitive in the AMM sector and basically a new approach. But I also want to learn more about how you designed it, how the design process looked like, how you organized the collaboration between researchers, smart contract development, and the Bancor DAO as well. And yeah, I'm very much looking forward to your talk. Thank you for coming.
Hello, everyone. Thank you for the introduction. This talk is actually going to dovetail remarkably well with the last one. I think that was by design. So Angela, thank you for putting together the speakers in a chronological order like that. My name is Mark Richardson. I've been with Bancor now since 2021, and I've taken over the CEO position for the project since October of last year with the development of our new product. And so part of this presentation is going to be very highly technical. If you don't understand the symbols on the screen, just listen to what I'm saying, okay? I will be interpreting it for you. It's important that we start at the beginning, okay? And I hope this isn't controversial, but Bancor is one of the most plagiarized protocols in the industry, right? We invented the AMM, and we have what's called the original Bancor formula, which is actually a big component of our intellectual property and our patent family. And the way that it works is essentially that it's a derivative of something called the Douglas-Cobb constant production formula, which if anyone is familiar with microeconomics, you may have seen that before. But here it's applied to token pricing rather than economic productivity. The reserve invariant here is just a simple expression that says that the total number of tokens inside a liquidity pool is always a function of the other tokens inside the same liquidity pool. The most basic version of this is the constant product formula, which was popularized in Uniswap v1 and Uniswap v2, and countless other forks of those protocols. The important thing here is that in Bancor's original implementation, we didn't have any restrictions on what the weights of each one of those tokens could be. So you could actually bias the overall portfolio value in the direction of one token should you want it, which was critical when we developed the protocol during sort of the ICO era. So there were a lot of projects that didn't want to do an ICO via traditional methods and would prefer to do it all on chain. And so having a reserve ratio constant that would allow market participants to interact with the token without crashing the price or without causing it to pump to some ridiculous or unbelievable level was critical. This is the graphical representation of it, which I hope we've all seen before. This is a conic section. This is actually a perfectly symmetrical hyperbola. And the important thing here for the purpose of this discussion is that you need a token balance on both axes to understand where you are in this coordinate grid, okay? So that brings us to the end of this component. The most significant part of it, though, is that this allows for what's called price discovery. No matter what is happening in the market at any one time, you can query the pool, and it will just tell you this is the price of that token, right? We call this a marginal price. This is essentially the price that you will pay if you trade nothing, right? If you trade 0 tokens. Because as soon as you trade a non-zero amount, the price slips, right, and moves away from you. And this is generally, you can think of it as a sort of a pragmatic understanding of supply-demand curves, if anyone has a strong economics background. Now that marginal price quote, it's still a function of all of the token balances in the pool. Okay, so this is the specific way to calculate it in Bancor's ecosystem, but also in Balancer, if anyone is familiar with the Balancer ecosystem. And again, the price, it has 2 tokens in it. In this case, it's got the token weights. But when we're also referring to another token balance. So here, all you're looking at is that this is basically the price of, let's say, the J token. And as the relative proportion of some other token, let's call that token I, as it starts to dominate the pool, the value of the J token goes up, right? If you've got a lot of I tokens, you don't really want to absorb any more from the market. So the supply-demand curve is kind of responding in an intuitive way. The special thing here is that that reserve function that I showed you, the invariant, is asymptotic at 0 in n dimensions. So if you have 3 tokens, you have 3 asymptotes at 0. It means that the pool will never run out of liquidity ever. It will just keep marking the price up and up and up and up, right? You can take it down to the last wave of a token, but the price there will be close to infinite, right? There will be no more tokens to buy because no one will pay that price. So that gives us price enumeration between 0 and infinity. But then with our V2 formula, so this is going back to June of 2020, we started to explore the concept of using virtual token reserves. Maybe you don't want to enumerate the price between 0 and infinity. Maybe you only want to enumerate prices between near where the market is and a little bit into the future, right? This is a much better use of capital because why provide liquidity for Bitcoin at $1 trillion if we're not expecting Bitcoin to get to $1 trillion anytime soon? So this is the proper way to describe that arrangement. And the way to depict it graphically is essentially to shrink the boundaries of your typical reserve, right? We're literally just pretending the liquidity pool has more tokens than it does, and then just trading with what it has. We coined this amplified liquidity. A notable market competitor ripped off the idea a year later and called it concentrated liquidity, but it's exactly the same idea. We still have 2 token balances, and this is key, right? Even though you're trading with virtual token reserves, those virtual token reserves predominantly don't exist, right? There's only a small proportion that actually represent actual tokens that you can trade with. So the pricing of this thing is still dependent on those token reserves. We haven't really got out of the woods in terms of being able to price something independent of something else. So the amplified marginal price quote looks like this, and you can apply that same sort of heuristic in order to understand how its price changes over time just by shrinking the boundaries of your window. So here, we still have the weighted ratio of now virtual token balances determining the price versus some of the other tokens. It doesn't really matter which one that you choose. But now, instead of enumerating the price between 0 and infinity, you can see that the price is actually hitting that boundary, right? There is a maximum and minimum price here. And so we now have this min-max sort of price range that we can decide to provide liquidity in. So this was Banco V2. Like I said, this is 2020. This is a very, very long time ago. There is a problem with this. When you are assuming that the price of a token should be dependent on the state of another token in your liquidity system, it necessarily makes that system dependent on all of the things inside it. I know that sounds like a redundant statement, but I'm going to show you exactly what I mean in just a second. So here, we have the price of J, whatever that token is, versus some balance of I. Like, why should that be true, right? If you are a market maker or just someone who's placing an order in a system, why do we necessarily require that you provide both of those tokens simultaneously? Because we need one to price the other. It's actually a design choice coming back from the early 2016, 2017 ICO era when Bancor was developed that assumed that projects would literally provide their own liquidity, right? If they raise a certain amount of capital, they have a moral imperative to make sure that the market participants that they're interacting with, just what we heard in the previous presentation, actually have a way to interact with a fair market, an open marketplace. So it would come from them. But then when Uniswap came out of the gates and they said, no, 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 the projects won't do it, the users will do it. Their community members will do it. Now we're in a slightly different situation because those people that are speculating on a token, they're not market makers, right? Sure, they're making markets, but they wouldn't categorize themselves as a market maker, right? What they're actually doing is speculating. I would rather buy a token at a certain price and sell it at a different price. But the financial primitive that you get out of this is not that at all. The financial primitive that you get out of this is, I will insure the market against any price movement, down or up. Would you sign that contract in crypto? I bet you that the price of ETH will not move. That is the insurance contract you buy when you provide liquidity on an AMM. It's fine for a project to do it because, like we said, they've got these oodles of tokens pouring out of cupboards that they can't do anything with. You may as well make markets with it. But for users, those are the tokens that they're speculating on. Why would you sign that insurance contract? So The other thing that it does is it creates exploits. Does anyone know what a sandwich attack is? Have you heard of sandwich attacks? Because it's actually derived from this flaw. The problem is that as the balance of I changes in one direction, sure, it affects the price of J, but a sandwich attacker can easily reverse that trade, put J back into the pool, put I back into the pool, and move the price back to where it was. The problem there is that if I see your trade coming through, I'm just going to change the balance, make you pay $1 trillion for that Bitcoin, and then back run the whole transaction. So what we really have in the AMM context, and I've got an animation that's going to, I think, make this a little bit easier to understand, is that you have prices of tokens always quoted in the balance of some other token. Okay? And again, that's not a design flaw given the purpose that we originally envisioned AMMs to serve. But from a trader perspective, this is insane. This makes no intuitive sense with the way that they actually want to trade markets. So the solution is just let the token price be denominated in its own balance. If I have a lot of tokens left, I will sell them maybe a little bit cheaper. But when I'm running out of tokens, let me mark the price up a little bit. And I don't need to refer to another token balance. I can do this with one token if I want to. Why not? The other thing is that it makes that, let me go back. It makes that trade irreversible. You cannot just put tokens back into that liquidity curve. If you buy those tokens from me, I'm sorry, no refunds, right? If you made that trade, that was the risk that you took. I have absolutely no obligation to you, the person who accepted my offer, to wear additional risk that if you change your mind, you should be able to trade it back with me, which is exactly the primitive that AMMs give the market. But again, if you are a token project, that makes sense, because you want your traders, the people that are speculating on that market, to feel very safe. But if they're trading against each other, it's PvP, right? It's literally someone's risk versus someone else's risk. And if they enter into that transaction with each other, there's nothing wrong with that. There is no refund requirement. So this is what we've developed recently. I'm not going to go through all of the math. If you want to see it, the invention disclosure is on our page. There are 300 equations in it, but this is the most important one. This is the marginal price formula. And what you'll notice is that it refers to only one token balance, right? It is agnostic, it is immune, it knows nothing about any of the other tokens associated with this position. I'm just going to quickly go through what some of these other terms are. A, which is the parameter that we use in the contracts, is called something else in the white paper, but this is basically telling you the relative width that a market maker is wanting to create a range with, right? So if you're offering a price between $1 and $2, that's a certain width, right? If it's between $1 and $4, that's a different width. So that's what that parameter is. This B value is just some point of reference. This is telling you either the maximum or minimum price, where to begin that width at. So if someone says my width is $4, but I want to start at 10, then we know that that means they're making a market between $10 and $14, as opposed to if I start at 50 cents, then it's between between 50 and 450. So this is just a point of reference that tells you where that width should be measured from. And then this Z value is maybe a little bit too advanced to get into in a 45-minute presentation, but this is essentially the maximum number of tokens that that position can hold before we need to start adjusting some of these other parameters. And so I've noted here that it can be dynamic. We actually do implement it dynamically on Carbon. But it's, we need to sort of get into the differential geometry a little bit more to really understand what this thing means. The other design principle behind Carbon is that there is no requirement that two tokens priced versus each other have to have the same price. In fact, that was unique to AMMs, right? If you go to Binance today, or Coinbase, right, or KuCoin, or wherever you're trading, the price to buy ETH is not the same as the price to sell ETH, right? And we call that the bid-ask spread. If you are asking to buy something from someone, they are incentivized to charge a higher price than what they could get if they just sold it to someone else, right? So if there is a bid for ETH at 1,800, you might find that the first offer is at 1,900. And so even though someone might say the price of ETH is 1,800, because that's what they can sell it for, it's like, yeah, but I want to buy it. It's like, oh, well, in that case, it's 1,900, which kind of comes back to this idea that there is no such thing as the price, right? And this is very, very closely related to the presentation from before, which is that, sure, you can sell like 10% of your tokens at a certain price, But once you've exhausted all of that material, then the rest of your tokens might become worthless, right? It does not make any sense to calculate a market cap by taking some marginal price and multiplying it by the total number of tokens. Never has. There's actually a really cool story about someone in Britain who became the richest person in the world by creating 5 trillion shares of stock, valuing it at $1 and selling one of them to his friend, and became a trillionaire overnight, and was then arrested. But this is important. So the way that I know that the notation here is confusing because you think that you should be able to split this thing upside down, but remember, these are 2 different functions in 2 different directions. So what we've invented is what I'm calling asymmetric liquidity. And it is something that is much more trader focused. It's something that is innate, I think, that is more intuitive for real people who aren't categorizing themselves as market makers, who aren't beholden to the objectives of the project, who are actually just speculating on a token and want to decide the price, the specific price that they buy at, the specific price that they sell at, and don't want to be sandwich attacked or front run or anything else. So let's look into a quick example here. So this is the ETH Bitcoin chart. On a constant product AMM, again, that primitive that you're buying is, I will agree to buy and sell at any price. Again, weird, right? Like, who would do that? Who would say, I will buy, you nominate the price, I will buy it from you, right? Or you tell me what to sell at, I will sell it to you. That's an AMM. Even Uniswap v3 is very close, except instead of saying I will buy and sell everywhere, instead we'll say I will buy and sell until I run out of liquidity. But at any point in this range, again, you choose the price and I will just agree to that price. Carbon is different. Carbon says I will only buy in this part and I will only sell in this part, okay? So it's, in a way, it's the opposite financial product to Uniswap v3. This comes back to a little bit on the development side of things. In order to explain this idea to my smart contract developers, it became very necessary to create something that they could sort of interact with, something that I could present and show, even to our users and investors and things. It's not enough to just write a white paper with 300 equations in it and say, go and do your homework and come back to me when you understand it. You need to actually give them something that they can sink their teeth into and really get that visceral, like you know it in your bones. The same way that you understand driving in your bones, but you might not be able to actually explain to someone else how to drive. So we have a market backtester. At the moment, it's closed source, but if you ask me for it, I'll just give it to you. And what we're going to do here is we're going to look at the ETH BTC chart from this range, and we're just choosing some arbitrary ETH portfolio valuation. And we're going to simulate all of Uniswap v2, Uniswap v3, and Carbon across this range. So here we're choosing a Bitcoin price of 12.99 to 15 ETH per BTC. And again, it's going to trade non-stop throughout that range. And for Carbon, we're going to split it, right? This has actually been geometrically split. So on a logarithmic scale, the actual width of these boundaries are, I think, pretty close. So Carbon is only going to buy in this part of the market, and it's only going to sell in this part of the market. The way that the simulator works is you can choose specifically which protocols you want to simulate, which animations you want, and whether or not you want the final summary plots. So let's look at how a constant product functions. For people in a TradFi universe, they tend to find this representation in the bottom left as being the most intuitive because it resembles an order book. And it actually took a few years for people to realize that you could present an AMM as a legitimate order book. And so you can see that it's got the depth chart, and as the price kind of wriggles around, it doesn't look like it, but the liquidity is actually moving. So because we're covering the price from wherever it currently is down to 0 and up to infinity, it's basically impossible to animate this in any way that would make sense. So it looks like it's always down the middle. Now what we're looking at here is as the price moves around, we're simulating a 100% efficient arbitrage. This price data is taken, I think, from the CoinGecko or CMC API. And then we're monitoring the portfolio versus HODL position in the top right. So when this is in the negative numbers, this is generally referred to as impermanent loss. And you can think of positive numbers as being impermanent gains. But if you are, again, from the TradFi world, you might just see this as P&L, same idea. On Uniswap v2, it's important to note that how the fee earnings work. So when someone trades against you, they just kind of leave some residue behind in the pool, which means that pool gets slightly bigger over time. Your pro rata ownership of the pool is the same, therefore you're entitled to withdraw more funds. So in the bottom right, those two bars are equal heights almost all the time because we don't actually know what the fees were paid in. All we know is how much bigger the pool was, or how much bigger the pool is now compared to how big it used to be. And so you can see Uniswap's not doing too bad, right? If you had actually provided on the ETH BTC pair over the last year or so, you actually might be up 1% compared to your starting hodl position, so not too bad. I'm going to fly through some of these other animations because there's quite a few of them, but you can see that I also animate this in a DeFi-centric context, which is people that aren't used to seeing a depth chart, but actually prefer to look at bonding curves. And this is the Uniswap v2 bonding curve. Now remember when I was talking about asymmetry and symmetry and the fact that you're always quoting one token's price versus the balance of another token? I think that is really well understood from this animation. You can see that these things move in tandem, right? When this one's moving up this direction, this one's moving the other direction. This is because the balance of one token is literally, so in the y-axis here, is the x-axis on the other chart. This is that symmetry. It means that the price is always tied to both token balances and you can never escape it. Okay, this is the summary. So at the end of that whole simulation, and if anyone wants to see the whole thing, I'm happy to share the presentation, or like I said, the simulated code so you can generate it yourself. We see that the blue line here, which is the portfolio value, whenever it's above the gold line, you're making money. Whenever it's below the gold line, you're losing money. So this is not too bad. I think Uniswap did finish with about a 1% gain here. Okay, so let's talk about standard concentrated liquidity dynamics for a second. In this one, what you're looking at is, again, exactly the same price chart, but now we're only providing liquidity between those ranges that we nominated at a couple of slides ago. Now you can see just how efficient Uniswap v3 is, right? This is concentrated liquidity really looking like it's worth something, because we're not even a couple of weeks in, and we're already at 0.5% higher gains than we were at Uniswap v2 after a year. But now look what's happening. As the price continues to move out of our range, our P&L goes crazy, right? We're now down at negative 15%, whereas on Uniswap v2, we never even got close to that level of loss. And this is why the best way to understand Uniswap v3 is that it is a leveraged Uniswap v2. Your upside is higher, but your downside is also higher, okay? And the depth chart here looks nuts, because as you're depleting liquidity from one side of the pool, there is no infinite liquidity after it to replenish it, okay? And this is, in a way, the exact problem that Uniswap v3 has created for token projects that are looking for de facto liquidity, is that you can run out of liquidity very quickly when you are, for example, needing to liquidate some tokens to pay the bills or whatever it happens to be. So token price is a lot less reliable in a system like this because it's a little bit more volatile. In Uniswap v3, we collect the fee tokens outside of the curve. So it's important to realize that the heights of these bars on the right don't necessarily have to be the same height, whereas they did on v2. Okay, again, quickly, on the invariance side of things, they still move in tandem, they're still paired together, they still are symmetric. But now you can see it's massively amplified. We no longer have that gentle curve up, to the upside and to the right. Okay, so how did it fare? Not too bad. So it looks like the hodl position was worth about 110, and the final position was worth about 130. But we'll return to that in just a moment. For asymmetric liquidity, and this is what Carbon is offering, you'll notice first that the depth chart doesn't respond the same way that Uniswap v3's did. As the liquidity here is being depleted, the price point that the user has set is not coming down to match it, right? We are continuing to observe the price bands that the user set. So if they said that I don't want to sell my Bitcoin for any less than 14 ETH, then we won't sell any Bitcoin until it gets to 14 ETH. This is exactly how the system works. On the smart contract side, this means that it's also very difficult to route. And we were actually, it seems, again, maybe something of a trendsetter, because we gave up on on-chain routing very early on in the development of Carbon and said, look, the only thing that matters is that the user's intentions are on-chain and that the execution is on-chain. Everything else can be abstracted into an SDK. And even if you don't like our SDK, you feel free to build your own, right? All of the information is there to get started, and all of the theory is very well explained in our white papers. And now, if you were here at the conference yesterday, Uniswap X has just announced that they're also giving up on on-chain routing and doing everything off-chain for that side of things. So it seems that, like, at the time, I was worried that this is something that the industry was going to reject, but it turns out that that was actually totally fine, and now the rest of the industry is actually headed that direction anyway. Something to note, the performance of this position is actually pretty good, right? And the reason is that it holds on to tokens longer, right? The HODL position is the thing that's hard to beat. So if you're always buying and selling at any price point, it kind of comes back to this idiom of trade well, not often. And Carbon is exactly that, right? It is the natural expression of the token holder's desire to sell and buy within the ranges that they choose. On the invariant function side, you can see with the asymmetry here is also demonstrated, I think, rather elegantly. As the liquidity is running out of this curve, you can see this curve is growing, but it's not moving, okay? So there is no nascent connection between the price of one token and the other. Here, what I'm simulating is what we call connected liquidity or rotating liquidity orders, where you can actually say, if I'm selling my BTC in this range, use the ETH that I've sold it for to buy BTC again when it comes back down. Okay, so this is very similar to grid trading if you're in Forex, or now it's been in crypto now for about a year, maybe a bit longer. But Carbon really is, you can think of it as an on-chain grid trading bot, but a gasless one, because all it does is report the prices and the market interacts with it as it wishes. So at the end of that simulation, you can see Carbon's actually done quite well. It looks like with the HODL position again, started about 110, but we've ended up pretty close to 140 something. So the simulator generates these kinds of readouts, okay? And again, this is what the sort of thing that I was talking about with my engineers, is this is the data, right? Like when we go to Tenderly or when we go to a testnet, when we're running arbitrary sort of transactions through the system, make sure that it replicates exactly this, because this is like the de facto truth of our system. And sure, there might be some accuracy or precision loss or something with respect to floating point versus fixed point arithmetic, but that's something that we can predict, right? So this is the system. And when you've got something that's so new, right, and so complex, that hasn't really been seen before, I think that this level of verification, not on the on the smart contract side with respect to bugs, but the fact that it's even been implemented in a way that matches the economic model is paramount. So if you're doing a DEX or a lending protocol or something from scratch, I highly recommend building a simulation like this one, because it has massively reduced the development time on this protocol. It is by far the most difficult, the most complex protocol we've ever built, and we built it in, I think, 4 months shorter time than any of our other protocols. And I think that this kind of development process is definitely a part of that. The other thing is that it allowed us to very early on start interacting with people that we thought would use the system, especially market makers. When we speak to them, and we've been speaking with them for years, about do you use DEXs, do you use Uniswap, do you use Bancor, like what are you doing? And it's like, no, we don't use them. And the reason is that it's prohibitively expensive to manage a position on a DEX. Even Uniswap v3, where you can choose your ranges, if the market is moving in a way that is, let's say, against your wishes, to constantly withdraw tokens, burn that NFT, put tokens back in the system, get a new NFT, this is a very gas-intensive operation. And so in this system, we made sure that the smart contracts were like, you want to change your position? Sure, just change the number on your NFT. That's it. There's no need to withdraw. There's no need to put tokens back. In fact, this system is so simple that it doesn't even have liquidity pools, right? And this means that it has a huge gas efficiency that for the first time means we're really having, let's say, productive conversations with market makers who are interested in doing stuff on chain. And I would say that it's good timing. With all the stuff that's happening with Binance, with the FTX collapse last year and things, I don't know about other people in the room, but anecdotally, I can tell you that there is now a lot more interest from legitimate players, right? The healthy, responsible market makers in the space that are actually trying to get off of centralized exchanges and move to a fully on-chain system. And this is designed with them in mind. The punchline here is that ability to make markets asymmetrically, and this is the same price chart using a similar range for Carbon and Uniswap v3. You can see the performance is much, much better. And it shouldn't come as any surprise. To make markets well, it's not automatic, right? They apply very, very sophisticated algorithms about moving their prices around, and they use a $300,000 a year subscription to the Bloomberg terminal to work out exactly where they should put stuff. Average users don't have that capability, and they have day jobs, right? They're making markets automatically was always meant for projects, was never meant for end users. This is the opposite. This is built for traders. And coming back to what is your token worth? Well, it's worth what people are willing to pay for it. This enumerates all of the people that are speculating on your token and exactly their price points. It will tell you, this is where the bids are, this is where the asks are, how much liquidity is there, and you can simulate transactions. If I interact with this market and take out those orders, what will the price be then, right? It's a much more detailed way, I think, of examining a market, and ironically, it's a much simpler one to interrogate at the same time. So that's Carbon. We have, just to show that this is out in the wild, we recently ran a trading competition. This is someone who managed to clear 7% ROI in only 30 days. And this is organic, right? This is no token emissions. This is, we're not paying them to do this. This is just, hey, where did you want to buy your link and where did you want to sell your link? And you can see here, they set up 2 discrete limit orders, and when the price came down here, they bought it, and when the price went up there, they sold it. And they didn't have to pay gas for any transaction other than the one associated with starting that position. And if they left that there, it will trade perpetually between those things. So I think this is a radically new paradigm, and I'm very thankful to have been invited here to share it with everyone. And thank you, Angela, and I'll take your questions and everything else.
Awesome, thank you, Mark. We have some time for questions. Any questions? Yeah.
Great presentation, Mark. Quick question. What kind of attack vectors does this equation open up to?
Can you repeat that?
What kind of attack vectors does it open your equation up to? So you've looked at the sandwich attack based on the previous bonding curves. You've spoken about it. What are the vulnerabilities of this existing equation?
Oh, well, yeah, so the equation itself is more a refactorization. So the fact that we're ignoring one of those token balances mean that you just need to find another reference point. So geometrically and algebraically, it's actually the same as the Bancor V2 formula, which is the same as the Uniswap V3 formula, which is the same as the Trader Joe concentrated liquidity formula. So algebraically, it's exactly the same. So there are no vulnerabilities with respect to smart contract risk or something that haven't already been thoroughly explored elsewhere in the ecosystem. The thing that it might have introduced is obviously we need to choose a reasonable realm of precision. And so I tried to keep this talk as concise as possible, but there is a version of this presentation where we get into, once you've done this and you want to compare the token prices of something like SHIB, which is practically worthless, and something like wrapped Bitcoin, which is 5 figures, and then you have to multiply that by the fact that wrapped Bitcoin is a 6-decimal token and Shiba Inu is an 18-decimal token, you realize very quickly that one of these tokens in terms of the other is worth 30 orders of magnitude more, right? And so trading, it's like asking a Ferrari dealership, how many Ferraris can you give me for this sandwich, right? Like a Ferrari is so much more valuable than a sandwich that it doesn't even make sense to try and buy a fraction of a Ferrari. But the opposite is fine. How many sandwiches can I get for this Ferrari? Yeah, I can give you that number with amazing precision. So the way that this formula is implemented, and I hope that you saw that it's actually relatively short, right? There's a single division, there's no exponentiation other than the square. We don't need a Taylor series or anything else to solve it. There's no numeric approximations. It is symbolically provable. And for that reason, our precision loss is very, very, very low. In fact, all of the data that we need to implement this system is stored in 3 blocks in memory. So yeah, it's so out in the open, and there's so little to interrogate that the vulnerability and attack surface area is much, much smaller compared to more complex protocols.
All right, any more questions? Thanks. Somewhere? I have a question, Mark. I know that Stefan Lösch was at your team. Can you say a little bit more how you set up the team and who was involved in collecting the requirements, coming up with this idea?
Of course. Yeah. Okay, so for those so Bancor has a chief economist. We always have. The first chief economist at Bancor was a gentleman named Bernard Litter, who was actually the co-creator of the euro. Right, so we come from fighting stock. After Bernard Litter passed away, we had to search around for basically someone with a similar background. We wanted someone who was an economics and financial academic, right? Maybe someone with a quantitative finance background, but has applied it to things like the regulatory landscape, which is becoming so much more valuable now with the chaos that's happening in the United States. And so Stefan Lösch is exactly that person. He was a quant trader. I think he ran the options desk on Wall Street for like 30 years or something. He's published a huge number of books on financial regulation and different economic devices and things. And so when I presented this model to him, it took a little while. What I found with Carbon early on is that after I had conceived of it, it wasn't a short conversation with anyone, because I didn't have the simulator, I only had half the equations. It wasn't something that people got immediately, right? It was even to the point where I eventually just started saying, forget about liquidity pools, forget about AMMs. It's not an AMM, this is something else. We're doing something else. When I finally got Stefan on the same page as me, it was really a matter of then going through let's say the financial definitions of what we're actually building. I would say that was his role then, I guess, as a mathematician, having someone to check everything that I'm doing. But then also he's an extremely experienced programmer, so solving the precision loss issue was something that he was very key to developing. And even now, as we approach other financial professionals, he and I are the people that lead those conversations. And you need someone that has that sort of, let's say, gift of the gab, right, when it comes to speaking financial language with other financial professionals. So that was a very big component of it. So it's not, so top to bottom, it was proof of the math, helping me validate the concept, that it even made economic sense, and then translating it into, let's say, correct financial language, and now contextualizing and discussing it in sort of a contemporary way with regard to where the rest of the industry is headed.
And some final words on then there was a DAO decision, right?
Of course. Yeah, so everything that we do on chain is determined by the Bancor DAO. So in a way, all I can do is think of things and present them to the DAO. And I think I take this personally very seriously. I have noted in other projects where a proposal might be, a few hundred words and maybe a figure. Some of the people in my DAO might resent me for this, but the things that I put up can be 100 to 1,000 pages and have like full mathematic proofs and economic sort of walkthroughs with examples and example code. With Carbon, I tried to not be as overbearing as that because I did want to get this to market very, very quickly. And so instead, what the process is essentially we waited for the provisional patent to be filed so that we could start speaking about stuff in public. Then it was a matter of warming the DAO up to the idea, having lots of one-on-one calls, public calls, Twitter spaces, Discord meetings, making sure that everyone that's involved in the project who held the token understood it and that they liked it, right? We can't do anything without their support. After that, it was the white paper development. and then presenting that to them and giving them time to process it. And that was a couple of months. And then the proposal, right? So it was really trying to keep all DAO members, or everyone who wants to be involved, everyone who wants to be informed, getting them access to everything that I'm doing at every stage of the process before there's even a proposal, right? When the proposal shows up, I wanted the DAO to already be familiar with all of the things that I'm discussing there. And then that also meant that the proposal could be much shorter, because we could then say, link to the white paper at this particular chapter or whatever is required for a certain component of it. And it also helped to organize it, right? There were certain decisions that we needed the DAO to propose. You can't just say, here's the project and here's the product, please approve this. There are, this is going to be the implementation of this bonding curve, yes or no. This is going to be the implementation of this monetization aspect of the protocol, yes or no. This is going to be so on, right? There are about, I think there were about half a dozen decisions relating to every aspect of the protocol that we needed the DAO to understand, and springing something this complex on them straight out of the gates and say, look, we're going to go to Snapshot in a week, please read, it's just not a practical way to do that. So it was really about making sure that they understood what was happening from its inception, minus the time it took to get the provisional filed, up until the proposal. This was, I think, a part of the process that we actually do quite well, and something that I encourage other projects to think about.
Awesome. Thank you so much for sharing, Mark. Thanks again for being on stage today.
Thank you, everyone.
And is there Gabe? Just taking a look, is Gabe already around?